So those who have joined now, my name is Rishabh Kale. I have been an equity research analyst since 8 years. I was working with sell-side firms and as well as with buy-side. Latest being working with Crisil. I was, though I was with Crisil, but I was working with HSBC on its payroll. So I was specifically working with HSBC Global Mutual Funds, where we used to look at the equity markets all across the globe. I started my career as an analyst in a small sell side firm in India named Arihant Capital, where I was covering pharmaceutical, IT, and automobile sector. Then eventually, I moved on to be a pharma analyst only, where I'm covering pharmaceutical sector almost 4 5 years, and then next 2 years I was with the HSBC, where I was working across the globe, not only in India but covering the entire globe, specifically the US markets and the Chinese market. So it's been around 8 to 10 years of experience into research. I joined teaching at the age of 29 something, where I was maybe 2 years back, where I'm teaching with associated with Wellington Institute of Management. If you guys know, it's one of the premium colleges in Mumbai, and few colleges as well, which are tier 2 college, you may say. So I am a financial modeling tutor over there. I have also been an CFA tutor. I teach CFA level 1 to students, Indian students settled abroad, and even online one-to-one coaching. I've been teaching this for the last 3 years. I myself, from an education point of view, I've done my BCom, I've done my MBA, and I've cleared CFA level 1, and also a tutor for CFA level 1 only. So yeah, so the point of organizing this seminar or webinar is because when I teach financial modeling, many a times there's a question that, sir, that you write off use assets, lease liabilities, deferred tax assets, and deferred tax liabilities. Now, those are the things which students fail to understand. So when I teach in Wellington, there are 80% crowd is engineers. They are from the science background. Even when I tell them, go and write or maybe punch numbers and come, everyone ignores this items. And when actually in the interviews, the question comes, we are like, we don't know what to do with this. So I hope many of you must also face the same issue. And first of all, in modeling, how to forecast this lease liabilities and write-off use assets. Deferred tax asset, deferred tax liabilities. I have done a session, last month. I'll share that link in the comment box when I post this on YouTube. But yeah, this is the error. This is the thing that I've found that students don't understand. Even my students at times, when I teach in classes, they are like, sir, I don't understand lease liabilities, write-off use assets. And that time it becomes very difficult because it's a different concept which cannot be taught with financial modeling. It's an accounting concept. So it is assumed that you know basics of accounting and then you do it. And it is not straightforward that lease liabilities is like an asset or lease liabilities is a liability. Do we have to pay rent on that? Do we have to pay interest on that? It is always a confusion. And specifically in CFA exams, if you know IFRS and US GAAP, there's a lot of questions asked on specific IS GAAP and US GAAP. What is the treatment of lease liabilities of right-of use assets? It is a part of FSA, the financial statement analysis subject. And you can, CFA guys can recollect these things. Now, let me go to the basic, what is exactly the lease liabilities. So let's start with blank Excel. I have a model which is made. Now, this is the model which is made by one of my students. So we have taken a lot of files are there, which says revenue forecasting, quarterly forecasting, revenue breakup. But here, when you see the balance sheet over here, now this is the Metro Brands annual report. Now you see from here, suddenly this number comes in. Sorry, right-of use assets. Okay. This number, if you see in any balance sheet, this number is not there before 2019. March 19, this number is not there. I will show you one of the balance sheet. 1 second. I'll show you one balance sheet of other companies where Now you don't get this kind of lease liabilities before certain period. I'll show you. Now this, okay, can you see this balance sheet? Now in this balance sheet, now this right of use assets. See, these numbers are there from 2014. This is Maruti's balance sheet. Now the right of use asset suddenly came over here. Suddenly a big number. Now this is like 600 crores, 6,000 millions. So it's not a small amount. It's not a small amount. And how did this amount come over here? Now what happens when you do modeling? You take last 5 years. You do this. You club this all and you make it. Many of them take it from money control and they club the balance sheet and then start modeling. But it is not actually. It's not the way you do it. You have to take numbers from annual report. These numbers I have punched. Being an analyst, being 8 years of experience, still we punch these numbers. Or still we tell our associates to punch these numbers because these numbers are perfect. Third-party websites numbers are not correct. Means they might be correct, but the format is different and which cannot help you to analyze the future. You see suddenly a 600 crores of assets being. So does it mean that Maruti have purchased 600 crores of assets? See, it isn't that way. What happened? India, as the AI Indian accounting standard system changed in 2019-20. So that time what happened? The accounting system states that you should also post or also report the balance, also report the assets which are taken on lease. You need to also report the assets which are taken on lease. Lease, I will say rather rent, okay? Because everyone is familiar with this word rent. When we stay on rent, do we say that this is our office, this is our home? When we stay on rent, no, we pay an rent expense, we pay a rent. So we don't say that is our house. No, it's like a rented house. But now what happens? Now let us take a company. Now, if you are comparing a company, okay. If you're comparing a company, let us say example, this Maruti, okay. Maruti and let's say Tata Motors, okay. Or let's say today Kia, okay. Kia was a new entrance, okay. Kia Motors, okay. See, Maruti has their own manufacturing plant. Okay, Maruti have their own manufacturing plant. They must have taken it few years back. Let us say Maruti have a plant of 1,000 crores. Same way, Kia Motors, let's say they have leased the plant, or maybe they have taken on rent. Now, usually when you take something for a longer period of time, it is called lease. For a shorter period of time, we call rent. You must have seen, 99-year lease on a land. 99-year lease, 99-year lease on a plant, or maybe 99-year lease on a land. You might have seen this, or you might have heard that your land is on 99-year lease. Now, when the rent is for longer years, it is called lease. Now, what happened? Let us say Maruti has a manufacturing plant. Let's say we'll talk about PPE, okay, and Kia Motors has taken that land on lease. It is not their own land. It is not their own land. So what happens when you look at the balance sheet? Kia Motors doesn't have any land or any plant because that is all on lease, and you don't report lease as your when you take a flat on rent, you don't report it as your own flat. So what happens as an outside investor? When an outside investor look at this balance sheet, he finds that Kia Motors has no plant. Let us say it has only 10 crores of land. Assume, okay, only 10 crores. Rest 900 crores, 100 crores. Rest 900 crores has been leased. Let 900 crores of land which is leased. Now what happens? Let us say Maruti is doing a sales of, let's say, 10,000 crores from this plant. And let's say Kia is also doing the same one. Okay. Kia is also doing the same sales. Now, when you talk about turnover ratios or when we talk about investment, see, Maruti has invested 1,000 crores and they are doing a sales of 10,000 crores. So if I divide this, can I say it is 10 times? 10 times the sales, invested 1,000 crores and doing a sales of 10,000. So Maruti is doing 10 times the sales of the amount invested. But same way when I look at Kia Motors, you see how is it? Kia is doing 100 times. Now, when you look at these two companies, it seems that Kia is using its assets very efficiently. With the same assets, with the sum, with only 100 crores of invested, they are doing 10,000 crores of sales. Whereas Maruti is invested 1,000 and they are doing a sales of only 10,000. It's just 10 times. Now, how is this possible? Now, here it means that Maruti is not a good company. Straight away with the ratios part, this is called your asset turnover. Now, this is exactly, it says that, or you can say that Maruti is a bad company compared to Kia Motors. Now, Kia has also invested 1,000 crores, but that 900 crores is on rent. Now, he is paying rent expenses on that. Now, what does India IS? Yeah, IS 16 says that you should also report this assets that you have taken on rent. Okay, but obviously you should not write it PP. You should not write PP. You have to give a different name of right of use assets. Right of use assets. Was it right of use assets? Okay. Here you know that this now it comes. Now you can take this. Now the 1,000 and 1,000. Now Maruti and Kia are at the same level. But this wasn't reflected in the balance sheet previously. So what happens when investors, when they look at this balance sheet, they used to get confused that how is this possible? Every time Kia Motors will look as a good company. Now, obviously, now when you take, you should add this as well. Now it is same. Now both the assets are same. Now see, now when you add an asset, obviously it is not your assets. It is not your assets. You have taken it on loan, right? So when you say that you have taken it on loan, it should also have a lease liabilities which is created on the liability side. The liability side, you should also create a lease liability. Lease liabilities of 900. Then only your balance sheet will tally. Now, let's say your equity was 1,000 over here. In Maruti, it was 100. Sorry, that was 100, and the rest was lease liabilities. Now, here your balance sheet tallies. Okay, this is how it works. Okay, got the concept that what is lease liabilities and why it is reflected. Right of use assets and lease liabilities reflected differently, just because this asset is taken on loan, and just to tell investors that Kia is also using this plant. Okay, though it is on lease, but they are this lease is like 100 years. It actually belongs to the company only. It actually belongs to the company only. So I'm not saying only land. It might be land, equipments, machineries. All those are taken on lease. No, nowadays you can also take car on lease. Zoom cars have given us 3 years on lease. Not lease, you say rent. But when the lease is for longer time, you call it as a rent. Okay. Got this? Now, this was the basic concept of coming up with right of use assets by India AS. And it came from 2019 only, 1920. Some you see in 19, some you see in 20. But I have never seen any student asking me, sir, why did it suddenly increase? Because why? You guys, those who make models, take numbers from money control. And it is all club. In money control, it is all club. So in my class, we have specifically said that numbers should be punched via annual reports only. Should not take, though it takes time for punching, you should punch the numbers. That is the time you understand all those differences. Suddenly you see an increase in liabilities. Okay. Now there is also concept in IFRS and US GAAP. Okay. IFRS and US GAAP. Which type of lease is this? Which type of lease is this? Now, there are two types. One is your operating lease, and one is your financing lease. Financing lease. Now, operating lease is considered same as your rent. Same as your rent. Rent expenses, which is shown as your other expenses in the P&L. Same way. Okay. And financing lease is this type of lease. Okay. That we talk about. See, if it's an operating lease, it will not be represented on the balance sheet, because it might not be a bigger. It might be a lease for an office space or something like that. So PP, so this financing lease are only reported on the balance sheet, and operating lease are usually a small amount. Now, financing lease has a criteria. Financing lease has a criteria. Now, what is that criteria? That at the end of the period, the asset should be transferred to the lessee. Lessee means the one who have taken these assets on lease. There is lessor. Lessor is the one who gives, and the lessee is the one who receives. Lessee means the one who uses the asset. Lessor is one who gives the asset. So now what happens? Now you say that, sir, why is this like this? Why would you purchase the asset back? And why would a lessor give the flat back to the lessee? What happens? Let us say you are running a car business. You are running a car business. I want car on rent. Okay, let's say lease. Let's say you have purchased the car of 10 lakhs. Let's say a Maruti Ertiga. I said that I want to buy on lease. I want to buy on lease. Okay. Now, let's say I purchase you for 10 years. Okay. Useful life. I purchase a car from you for a 10-year on lease. And let's say, no, I might be paying a rent of how much rent? 2% in India, it is 2% yield. Any rent you take it around 2%. So I'm paying you rent around 20,000 per year. Per year, huh? This is per year. 2% is for per year. Okay. Now 20,000 I'm paying per year, and then I will only pay 2 lakhs. After 10 years, I will only pay 2 lakhs. And now if I give you this car back after 10 years, would it even be in a condition to run? Or what will you do with that car after 10 years? Now this question comes. Now, okay, in the land or building, you might say that, okay, land is fine because the land value appreciates. Even in the building value depreciates. If the building is 30, 40 years old, because you need to have a redevelopment for the building. The prices usually for the building, the furnitures and all depreciates. Okay, only the land is an asset which the value appreciates. The rest, all other assets, the values are depreciating only. Means the value keeps on decreasing every year. Now you tell me now what you will do with this car. I have only paid you 2 lakhs. After 10 years, and I might have used it roughly. I might have used it 1 lakh kilometers. It's on me. I'm paying you the rent. Now what will you do with this car? Now it's a waste for you. It's a scrap. And can I say then you suffered a loss of 8 lakhs rupees? Let's say this car goes into scrap. You pay rent 20,000 per year into 10 years. I will only pay 2 lakhs. Now are you happy with this? Obviously, it's a loss-making business. It is a loss-making business. Now, what happens when you lease something? When you are into a leasing business, you don't give car on rent. It is not like that. There is called a finance lease. It is a finance lease. Now, this type of lease will be a finance lease where, at the end of 10 years, I will take the car from you. I will take the car from you. Why? Because obviously it is of no use to you. This 10 years, what will you do with this car? I might use it. And that lease, when you take the car on rent, when I take the car on rent, it has been there in the agreement that the lessee will purchase the car. Lessee will purchase the car at the end of the period. This is same as purchasing house on loan. This is same as purchasing house on loan. When you purchase a house on loan, the loan is for 15 to 20 years. Ask your parents if you don't know. The house is of 15 to 20 years. You keep on paying EMIs. You keep on paying EMIs. Now, it is a straightforward relation that you take loans from the bank, you go and buy a house, and you pay the rent or you pay the EMI to the bank. Now, here what happens? A car leasing company, let us take Ola. A car leasing company, Ola, will give you the car as a loan. Will give you the car as a loan, and you will pay the EMI. You will not pay rent. You will pay the EMI to Ola. How it works. I will tell you how it works. Let us do it for 5 years. Car of 10 lakh is assumed to be given as a loan of 10 lakhs. Okay. Car as an asset you give, but it is said to be you have taken a loan of 10 lakhs, and in that sense you have got a car. So it works like that. A lease liabilities is reported in your balance sheet at 10 lakhs, and at the same time, since since IFRS says that you have to report it as right of use assets, so you have to use a right of use, not IFRS, so the India AS, right of use assets also is created in front of it at 10 lakhs at the same amount. Two assets are created. I mean, one liability is created and one is asset. Because see, you have not taken a loan. The cash has not been received. You have taken this car on loan, which is given by Ola only. Which is given by Ola. Now what happens? Now this assets will have a depreciation. The useful life is 5 years. Lease liabilities, you have to pay a rent or you have to pay an EMI for the next 5 years. Now how to get this EMI? Clear everyone? Acha, any doubts before we proceed? Vinay has a doubt. Is financingly similar to? Yeah, similar to hire purchase. Yep. But in that you have to purchase the asset back. Any doubts, guys? You can write in the chat box and raise hands. I will unmute you. Any doubts, guys? Before we move ahead. Lease liability is same as a car taken on loan, but you don't exactly take the loan. The loan is given to you by the company only. It is not that you take a loan from a bank and then you go and buy an assets and you create a loan over here and assets over here. It is like take a loan from the bank, from the company, and it gives a right of use asset is created. See, till you have not paid off the loan, you cannot write it as an asset. You cannot write it as an asset. You also write it as, you have to write it as a right of use only, because it is not your asset. See, when you purchase a flat, till you don't pay the entire loan amount, you cannot say that it's an asset. Banks also have a stake in your, I mean, the house belongs to the bank only. You cannot sell it. So Ritik, sir, is it necessary to buy the assets at the end of the period? See, Ritik, what will I do with this car? Let's say I gave you this car and you use it for 5 to 10 years, let's say 5 years. The value would have been almost zero, like scrap value. And what will I do? Now, this lease is not for 5 years, it is usually for 15, 20 years. After 20 years of assets, what will I do with the asset? What will I do with it? No, I have to scrap only. So why will I take it back? I will say you take it on your own. You have to pay me the EMI. So it is like buying a flat on loan. Buying a flat on road. This same concept. When you buy a flat, it is like you report loan, and you cannot report it as an asset. You cannot report it as your asset. You have to report it as right of use, because it is not your asset, because it is taken on loan. Okay. So that is the point of finance lease. Or else it's an operating lease. It is like rent. After you pay the rent, you give back means once your work is done, you give back the property to the client. But now what happens, that rent for flats are fine when you take a flat, because now land is an appreciating part. But when you take assets on rent, like car, like an equipment, like a machineries, that cannot be taken back. What will I do with that after 10 years? And that's so it will not be in a position to run as well also. That is why the lease is created. Now this lease, I will tell you where it is used the most. It is used in the airline industry. It is used in the airline industry. Now what is that? Airline industries. Why? Because when they purchase flights, companies don't have money to buy the flight outright. They don't have that much of money because a flight cost in crores. People don't have that much of money. So what happens? They take on lease. Now the Boeing company will give their flights on lease to, let's say, Air India. Okay. Now Air India will not buy directly. They will take it as a loan. Means they will say that I am taking your flight on lease. It is like I am taking your flight on lease. Air India will say to the Boeing that I will take your flight on lease. And that time, why will Boeing give? Why will Boeing give on lease? Because they will get an interest. And that is their business model for Boeing. Because obviously no one can purchase the big assets. Okay, Tata, Air India might purchase 1 to 5 flights. But let's say what they have to purchase 50 flights. They cannot purchase outright. Now this happens in the airline industries. A small airline industries, all the assets are on lease. Now see, if it's on lease, it is like taking on rent. So you don't report anything on the balance sheet. You don't report anything on the balance sheet. And what happens at the end, you report. If it was normal scenario. In normal scenario, as just Ritik mentioned, that why it is necessary to buy back. Now, if it wasn't a part, if India IS didn't say that to write lease liabilities, see, I would have never reported flight as my assets. Nor even lease liabilities as my loan. I will have reported as my rent expense. Now, if I report this as a rent expense, as an analyst, in the balance sheet, you will never find my assets. But still, my revenues, I am generating revenues. How? Without a flight, how are you generating? See, no one comes to your office and see how many flats you have, how many flights you have. It is always there on the balance sheet. And this lease, the flight lease cannot be operating lease, because operating lease says that at the end, you have to give back to the lessor whose property belongs to. It is not your own property. So I will rather say that staying on rent, it will answer your question. Operating lease is staying on rent. Finance and lease is taking assets, taking flat on EMIs. Taking flat on EMIs. Okay, taking a flat on EMI. Taking a house, I'll say taking a house on EMI. So now, Mahfouz, that is why the accounting standard came in, why you should put it on asset as well as liabilities. See, if I say that you have taken a house, how did you purchase it? You're taking loan. Okay. So you report liabilities that you have taken a loan. Okay. Again, and give an example. Let's say I put this. Okay. Let us say it's your first liabilities and assets. Okay. What happens? You have taken a loan. Let's say you want to take a flat. You have taken a loan that is a debt of, let's say, 1 crore. Taken a debt of crore. And when you take a debt of crore, what happens? You get a cash of 1 crore. This is how the balance sheet tallies. You get a cash of 1 crore. Right. And with this cash, you go and purchase a house. Okay. But since that house is not yours, you have taken it on rent. So you have taken it on EMI. That house also belongs to the bank. So you cannot report it as your asset. You cannot report it as your asset. You will report it as an expense. From this cash you pay EMIs, you will report that as an expense in the other equity. If you understand what I'm saying, this is a part of financial modeling. Or if you understand what I'm saying, you will report this cash you got 1 crore, and then every time you will report it as your expenses. Okay, that you are paying expenses. You will not report it as your assets. It is just the loan, or you will say just the loan that is there you have taken, and you will report it as your assets. So EMI is what? EMI is your expense, no? EMI is paying your principal and paying your interest. So interest will be deducted from reserves, and debt will keep on reducing from over here. So this is how it will be reported, cash, and the cash will keep on reducing. You cannot report it as an asset, but it is not your that you have taken on loan. Okay. Yeah, lessee will, Advait. So Advait is asking, so lessee will report this as expense on the P&L. Yeah, lessee will report this as an expense on the P&L. In operating lease, it will report as an expense. Okay. Chinendu is asking, can you record it as a liability in balance sheet? Obviously, when you take a loan, you report it on a liability, on an asset, on a liability side. So after paying this, it will be yours. After paying off the debt, it will be yours. Then you can report it. Before that, you cannot report it. You cannot say, can you say it's your asset? See, you cannot say. You go and ask, your parents, or maybe your CA is in the house. They might be knowing it. You cannot report the flat as your own flat. You have to report some part of it as an land, because let's say whatever loan you have paid, that is the only ownership. You cannot report the flat as your own. It is the bank's flat. Now, even the car, when you take on loan, hypothecation, if you guys know, on the RC book it comes hypothecated to bank. So it is not the car that you also purchase, it is not your own car till you pay the entire loan. So once you pay, obviously, then an asset gets created over here. But before that, no, it will not. I'm coming on it. Now, how to report this? Yeah. This you got. Just simple that operating is rent, that is staying on rent, and financing lease is taking on EMIs. Financing link is taking on EMIs. Okay, now yes, yeah. So your Advait was asking what about? So obviously rent is your expense which reflects in your P&L. In your P&L. Acha, what about EMIs? In EMI, you pay the interest and the principal. You pay the interest and the principal. You pay the interest as well as the. So you pay both. But the reporting part is different. Say a reporting part is different. How it is reported? Interest is reported in the P&L, and principal is repayment. Now, principal repayment is reported as a cash flow from financing. Cash flow from financing. Cash outflow from financing. This is how it is reported. Interest and principal repayment from cash flow from financing. Here specifically it is reported as P&L. Here the interest is P&L. Now interest also, which activity is interest? When you talk about FCFF, those who guys know, the students over here, what you do with interest is a financing activity. And now what happens if there's a US GAAP? Okay, if the financing lease is based on the US GAAP says that interest is a operating activity. They don't consider it as a financing activity. Operating activity. US GAAP says that it is an operating activity. Only for US GAAP. US GAAP says it is an operating activity, whereas IFRS have the choice to say that, okay, sorry. Whereas IFRS have the choice to say that whether it is an operating or IFRS, you have a choice whether it is operating or financing. So in India, though, it is financing only. But when you look at US companies, you might see that interest is a part of operating activity and it is not added back in PAT. Okay. It is not added back in PAT when you do the FCFF. Operating and financing. Operating or financing. This is how it is reported. Okay. This is how it is reported. That can also, that depends on company to company, whether they want to capitalize on not. Okay, so Ritik is asking, I also heard that interest paid on purchase of fixed assets can be capitalized. Yeah. Interest paid can be capitalized. This interest that you pay can also be capitalized and be reported as your in the asset directly if you don't want to show it on the P&L. But ideally, that doesn't work in this part because this is on ideally on rent. So this is you have loan. This is a loan that you have taken to buy that asset. So it doesn't work in this part, but you can take it given a choice. Yeah. Okay. Now the question comes that, sir, why is the lease liabilities and right of use assets always different? Why the lease liabilities on the balance sheet? Your right of use is different and your lease liabilities are different. Why is it? Why is it different? Why the numbers are always, it should be same, no? We just now discussed that the loan that you take and the assets that you use should be same because you have taken on that. 301, it is discounting, but what happens that when you tell something about this to a student or maybe a guy who's a 15-year-old guy, maybe 11, 12 standard, you don't understand what is PV. You don't understand what is PV. Let's take a very basic example again, very simple example, which everyone knows. Everyone must have come through this in their life. Okay, when I take a loan, okay, principal, take a loan, okay, principal. Let us say I take a loan of 1 crore rupees, okay. Crore is like 10 million. Those are not from India, it is a 10 million, okay. Principal loan, okay, principal loan that you have taken, then you have to pay interest rate. So in India, the home loan interest is around 7%, 7 to 8%. So let's take around, okay, the car loan in India is around 10%. So I say, okay, you take a car, this lease liabilities, a car, a 1 crore car, interest of 10%. Now I say that you have taken it for 5 years. You have taken this car for 5 years. Now obviously you have to pay back. Now, if you guys know, when you pay a flat, pay a EMI for the flat, the EMI is called the equated monthly installment. Equated monthly installment. Now I'm taken an annual installment only directly. I'm taken as an annual installment. So it is called PMT, payments per year. Okay, payments per year. Or I will rather also EMI. So this is monthly, but I'm taking annually only as of now to tell you guys because balance sheets are on an annual basis. So what happens when you put this formula, PMT in Excel, rate is 10%. Okay. NPR is a number of period 5. Present value, now I put a minus sign, and this is the loan that you have taken. Okay. Yeah. Loan that you have taken, the present value, because this is what you have to pay, right? This is what you have to pay back. So here comes your EMI. This is 26 lakhs you will pay on an every year to the bank. Now let's create a schedule. Now this is a part of CFA non-current liabilities, the bonds are also treated in the same way. So just keep a, see this consciously. Principal amount, the beginning, I'll say beginning principal. Same concept is used in bond valuation. Beginning balance. Point is that we are told in such a difficult way, we don't understand what is it. EMI. So EMI, I know it's a part of, I will tell it monthly. So EMI. Then, so EMI is consist of, it is consist of two, interest and the principal repayment. Principal repayment. And now it is the closing balance. Closing balance means how much is the loan at the end of the year. Now let us say the beginning balance, I have taken a loan of 1 lakh. What is the EMI that I pay? EMI that I pay was around 26 lakhs. So out of this, now what is interest and what is principal? I'll say EMI is a part of interest I plus principal repayment. Okay, I plus PR. Now, interest will be, you have taken a loan of 1 crore and the interest rate is around 10%. So you pay an interest of around 10 lakhs. So out of this 26 lakhs, 10 lakhs is the interest. So the remaining amount, can I say, is the principal repaid? 16 lakhs you have paid in the first year. 16 lakh you have paid in the first year. So now 1 crore was your interest. Sorry, 1 crore was your loan and principal repayment was 16 lakhs. So now the remaining loan is 83 lakhs, right? Now the remaining loan is around 83 lakhs. Okay. Now obviously from the second year, you start with this beginning. EMI is same because EMI is, you will pay the same. So you have taken a loan for 1, 2, 3, 4, 5. You have taken it for 5 years. EMI will be same. Now what will be the interest? Now interest will be on the beginning balance. Again, now the loan that you have is around 83 lakhs and you pay interest on this. I'll freeze this amount. 8,36,000. Now out of this principal repayment, I can just copy paste this or I can again do it. 83 lakhs was the beginning balance. Out of that, 8,36,000 is what you have paid. Is 75 lakhs and the closing balance is beginning minus principal. See, this is the basic stuff that you need to understand. Basic stuff that you need to understand. Let us say it should tally. Now, if it's not tallying, then I am sorry. Did I take? At the end, what happens that, okay, 1, 2, 3. This should come to 0. Okay, I think I messed out something over here. Let me check what happened. 10 lakhs. Second year, this is the, oh, sorry. Sorry. That's what. Sorry, this was right. I think I messed it over here. Interest was, okay, let me do this. Okay, interest was 10 lakhs. Principal payment was this minus this. Sorry. It should tally. I did the mistake. It should tally. You see, it tallies. Means what? At the end of 5 years, you have paid off your loan. You have paid off your loan. Okay. Got it? Means what? See, this is like same. Now your flat becomes, you are the owner of the flat now. Now you're owner of this asset. You are the owner of this asset. Now, this was part of your lease. So this is how the lease liabilities work. Lease liabilities work. This is how the lease liabilities work. Okay. Now, same way, the right of use assets. Okay. Now here, how will you report? You will report interest as in the P&L and the principal repayment in the CFF. See, both is outflow only. 26 lakhs is the outflow, but 10 lakhs will be reported in the P&L and 16 lakhs will be reported as an outflow in the balance sheet or in the cash flow statement. And obviously your debt will reduce. See, this was the lease liabilities. Second year, your lease liabilities will be this 83 lakhs. Opening balance, closing balance. Second year, your lease liabilities will be this. Third year, your lease liabilities. Fourth year, and at the end, it will be zero. At the end of starting of fourth year, it will be 23 lakhs, and at the end of fifth year, it will be zero. The same way, how does the right of use assets? Now, this is depreciation. 1 crore assets. You have purchased an asset for 1 crore. Useful life was 5 years. Now, depreciation per year is on straight line basis. It is all on straight line basis. Depreciation will be 1 crore divided by 5. That is 20 lakhs. This is straightforward. Now, depreciation, we do this opening balance. Add, then your less depreciation. Your closing balance. You also do add over here. If you want, you can do it. But since we have taken out one asset, add purchases. Add capex rather. So, our opening balance was this. Okay. Road, capex. Okay. Depreciation we have done 20 lakhs. Closing will be. This is the closing. This closing will come over here. Depreciation will be same across for 1, 2, 3, 1, 2, 3, 4, and the fifth year. That's it. Just do it. And then you get a zero amount. Guys, wait, before asking doubt, I will open the floor for questions. That time you ask. Okay. Don't ask in between. I will. Okay. See, now here what happens, you will report depreciation in the first year. This is year 1. Year 1, 2, 3, 4, 5. Okay. Now what happens when you report on the balance sheet? What all things will you report? You will report interest. Not about. So this right of use assets, first year it was 1 lakh, 1 crore. Next year it will be 80 lakhs, then 60 lakhs, 40 lakhs, and then 20 lakhs. And this is how the balance sheet will get tallied. See, at the end, both the numbers are zero. Means this loan you have paid off and this assets. Now here what happens in the lease liabilities, this assets, whatever the price is over here, the market value, you have to purchase at the market value. Usually there is some scrappage value over here. So you don't get exact zero amount, but whatever the price is, you pay it and get your assets done, or you sell it as a scrap. It's on you. Here what happens, the Ola one has received its money, right? They have received their 10 lakhs back, 1 crore back with the interest that you also paid this interest. So in financing lease, see what all expenses are there. Financing lease, you get interest, you get depreciation. Okay. And you get this interest benefits, you get the depreciation benefits, and the cash flow statement, you write it as a CF1 financing. Solid report, your interest will be 10 lakh For the first year, depreciation will be 20 lakhs for the first year, and then the cash outflow will be 26 lakhs at the end of the year. Okay. This is how it works. Now you will say, sir, that 6 lakhs, what happens to 6 lakhs? Is what is the difference? 30 lakhs. And there is a cash outflow is around. So what do you do with depreciation? Depreciation is added back in the cash flow statement. Right? Depreciation is added back in the cash flow statement. This is how the concept actually works. Now, what is the difference between financing lease and operating lease? No. See, operating lease, you only report. Operating lease, you will only report as rent expense in the P&L. The rent expense in the P&L that might be around 26 lakhs. Okay, that might be around 26 lakhs. So what happens? See, what happens in operating lease? In operating lease, can I say you get a higher expenses at the end, at the start? Profitability for operating lease will be lower, because obviously the rent will see it has been divided. Now it has been, see, EMI, you don't report 26 lakhs totally. Depreciation is still a non-cash. What was the actual expense? Was 10 lakhs. See the cash, this is CFF. Okay, in year it will be CFO. In operating lease it will be a CFO because it is said to be an operating part. So what happens? This rent, the operating leases, usually the profitability is lower. Profitability is lower. Profitability is lower in the first year. Few years it is lower, and then you see over here the interest goes on decreasing. Interest goes on decreasing every year. The expenses will go on decreasing every year. Okay. Availability higher for this company, and this will be lower. Now why? Because every year the interest expense will go on decreasing. Interest expense, right? And the rent will be same. Rent will be same. Every year rent will be same. But here what happens? Because it is a amortizing basis, this goes on decreasing. I'll show you total expenses. Total expenses is 30 lakhs over here. Let us assume it was 26 lakhs. Okay, just 26 lakhs, whatever the EMI that you pay. Okay, for rent. Just assuming that both are on the constant basis. But here 30 lakhs, and then I will do it transpose. Acha, now now this is in a horizontal, vertical way. This is in the horizontal because we make models in horizontal. We don't make vertical models. Now how to take it over here? You say, sir, do transpose. Okay, if I do it transpose, what happens? Copy, and I do it. Okay, you say I do it transpose. Okay, I do it transpose. Since it is link, it will not come as a transpose. I will say, sir, okay, then do what paste values. Okay, I do it paste values. Now it's fine, it came. But what if I change the interest rate over here? This will not change. H lookup is not that feasible. See, so H lookup, you have to put a lot of formulas. I will do it in a very simple way. What I do is I select this all. Same way, transpose only. What I do, see, now there's a function in Excel says transpose. See, first I've selected 1, 2, 3, 4, 5 I've selected because I know that I have to take 5 numbers from over here. I select the entire array, 5, close the bracket. I don't press enter. What I press is Control Shift Enter. Control Shift Enter. See now what happened. has taken the link. I change number from here. Let us say I change my interest to 15%. It will automatically change my interest. Will automatically change my interest. Okay. All right. This is how it works in financial models. So in model, you will create one like this, the lease liabilities part, and okay, right of use assets. So we have created right of use assets. So this is like same like creating your depreciation schedule. Same way. Now I have taken it as a straight line method because that is the most used method in financial modeling. But this is straightforward. Okay. So straightforward. Opening years you have. For this term, when you put this into your financial model, your main sheet, it becomes difficult. So I do it transpose. Depreciation though we already have, it was same. Now what was your total expenses? The total expenses keeps on decreasing. You see, total expenses keeps on decreasing, whereas your rent expense is constant for the next 5 years. Assuming it is usually constant. The EMI that you pay and the operating operating part is the operating expense will be remain constant because you will pay the same rent. See, here also CFF will be same. Okay, CFF will be same, but the total expenses decreases. So profitability higher in the first year, and lower in the subsequent year compared to finance lease. Okay, compared to finance lease. Okay. Here also, now this is the second way. It will be higher. Profitability will be higher. Profitability will be higher. Sorry, profitability will be lower. It will be lower in the first year. In the first year. And higher in the subsequent year. In the subsequent year. So this, remember, those who are doing CFA, or maybe in the exams, MBA exams, they ask you this stuff, that what is the profitability? Will the profit be higher? So what happens in this year, if one is using finance, one is using operating lease, the profitability will differ a lot. Okay. Depending on what type of lease you are using. Okay. So before we move on to the actual model, okay, any doubts? We have few doubts over here. If you any doubts, you can write in the chat box, so that others can also see. If you own so Chinando is asking, if you owning a loan and you pay off large sum of the loan at once, it will reflect in a regular interest pay. So if you pay large sums, it will reduce your principal. So this is the principal that you have to pay till now. And it is like paying off your principal repayment. It is less, you don't pay this, you pay more amount. That's it. Now all your then EMI then will change. If you pay off, let's say at the second year, it is 65 lakhs you have to pay. Out of 65 lakhs, you pay 30 lakhs. So it is on the bank that what they do. Do they want to reduce the EMIs or do they want to reduce the number of years? So the whole calculation will change. Now, it practically it happens. You don't have to forecast anything in the financial model. Satyam is asking, if we pay first EMI of finance lease, I just wanted to understand how it will affect the balance sheet. Okay, fine, I will do it. Satyam, how it affects the balance sheet, I will let you know. Adil, so payoff will be directly expenses. There won't be any assets created. So Adil is asking, can you explain briefly how the payoff schedule would look like for operating leases, considering we have operating lease liability in US GAAP? So in Adil, operating lease liability is same. It is like you just take an expense on your P&L account. That's it. There will be no impact on the balance sheet. Nothing. No payoff, nothing. It is like you take a flat on rent, you give rent. How will you report in your P&L statement that you are giving rent to the owner? That's it. It's your normal expense, like another expense. The things comes on the EMI, on the financing lease. All this changes happens on the financing lease. Okay. I will share you this sheet. I'll share this sheet. Let me do this better way. So now few things are remaining over here is that let me ask Satyam's question. Satyam was asking that how will it impact the. Yeah, I will upload this on YouTube, so you can have a look on the YouTube as well. Okay. Let's go to the reporting part. Let's go. This is what we have done. Let's report this on the cash flow statement. Okay. So I create a balance sheet. Okay. First balance sheet. Okay. Liabilities. Okay. Dummy balance sheet. Liabilities. Okay. That is your equity and your, that's a lease liability. Okay. Lease liabilities. Second is your assets. Okay. The equity. Lease liabilities as a equity, let's say it was 100,000. Okay. When we first started, we have taken a lease liability of, so it was a beginning balance. Okay. For the first year, not from over here. Okay. Let's start with this crore. One first day you have taken, and then your right of use asset. Will be same as 1 crore. And then your cash, obviously there will be some cash which you have turned up equity. Okay. Cash will be. These are the balance sheet tallies. Okay. You only have this cash you have raised and you have taken assets on loan. Okay. And let us go to the second year. Equity will be same, right? Lease liabilities. We know that lease liabilities, second year it was 83 lakhs. Okay. And I will also create a cash flow statement over here. Cash flow statement. So first year we have a cash balance, opening balance, and a closing balance. And a closing balance. So closing balance, we know our first year it was 100,000. Okay. So obviously this year 1, and we will go to year 2. Okay. Assuming that loan you have taken at the end of first year. Opening balance is 1 lakh. Yeah. Okay. Now what happens? Now we have done, P&L also. Let's talk about P&L expenses. Let us say we have done a sales of 5 lakhs, 50 lakhs. Let us say we have done a sales of 50. This is the cash flow statement. This is your P&L statement. This is your balance sheet. Okay. Just creating 3 boxes. This is your total. And let us see what is the impact on the lease liabilities. Next year becomes how much? It becomes 83. I will link this. It becomes 83. Okay. What about right of use assets? Right of use assets next year becomes 80. Right? Right of year becomes 80. Now you see the differences around. This is what you get a difference. Okay. First of all. Now let's assume that what happened on the P&L statement. What happens? You took an interest expense. You took an interest expense of how much? Interest expense we have created. It was 10 lakhs. It was 10 lakhs. Then your depreciation. Now I've told you 2 things. Depreciation was 20 lakhs. Okay. Then will be other now Pat, now assuming there is no taxes, let's not go into that details. So 50 lakhs minus interest minus depreciation. But 20 lakhs is your profit. Now this 20 lakhs will be a part of other equity. Do you agree? $20 lakhs will be a part of other equity. Okay. Same way, you have done sales. Your sales would have been 50 lakhs. Cash money received. Or let's start from an indirect method. Those who know the indirect part, profit after tax. We started with P&L and then we add back depreciation. Achha, do I need to add back interest? Do I need to add back interest? See, if it was an operating activity, then yes, I would have added back and subtracted from the financing activity. Okay. Since I have not divided it, assuming it is all an operating expense. Okay. It is already included in the PAT, so you don't need to add back. But if this was an financing activity, then yes, I need to add it back and then subtract it back from the financing activity. So overall, the impact is same. Overall, the impact is same. Okay. Now your cash comes at, this is your cash. 41 lakhs is your cash. Okay. Now there's an exact difference of 16 lakh, that is principal repayment. What was that? What was principal repayment? Cash outflow, no? You see, you got an exact difference. This is what? Yeah, this is, it is a principal that is remaining. Principal repayment. Principal repayment. It was around is equal to minus sign. Minus sign was this principal repayment was this. And then your balance sheet tallies. So it is that simple, but we have just complicated. Now, what happens in the books now? In financial books, how it is written? Now, this is said to be an operating activity, right? This you said. Let's go with our, this is said to be an operating activity. So what do? You add back interest. You add interest. And there is 1 minus T. Now, here the tax rate is not there. What I will do? I will add back interest. Okay. This, then it is a CFO. My CFO is this. My total CFO. Okay, investing I have not taken because it is not a part of investing. It was a part of financing. Principal repayment. Now, what do you do in the CFF? Interest. Again, you subtract interest. Interest paid is equal to minus sign. That is interest paid. This. Okay. Then your total CFF. Total CFF comes to this. And then the closing cash earned for the year. Cash earned for the year. Total CFF plus CFO. Right. The cash earned for the year. And then cash earned for the year plus the opening balance. What is remaining? Did I miss out something? Oops, sorry. This is a part of CFO. Okay. This is how it tallies. Now, the problem is that if I would have taught you in this way, directly, indirect method, it is so confusing to understand. See, the same thing, I have put so many steps. The same thing, it was the same thing. What came in, what went out. But in the actual financial textbooks, it is written in such a difficult way. Here you don't understand. Here you don't understand. What is it? Now, this is what it looks like practically. This is what the entire cash flow statement looks like. See this. How confusing is this? Where are the things changing you don't even know? Now, when you do this, when you do it just now, when I did it, the easier method, you directly get the differences. You get the 16 lakh, which is there. This is a part of your lease liability. Satyam, you got it? So the finance is actually easy. We have just complicated things because we are taught in such a difficult way. This whole statement. So when we started our financial modeling, now many students are there from my batch. We have started it from base. Like this only I started. I started with making our own balance sheet. Once you understand this, obviously you can make changes. Now, if you are, if you are more enthusiastic, you can, make it more dynamic. Whatever, you can put more ifs and buts, and you can change. You can change your formatting. You can do it in a better way. I have just told you how it works, how the finance works. Okay. Okay. Any doubts? Any doubts? Before we proceed, the actual, I will show you how the actual numbers work in the financial model. Those who have made a financial model, that guys can relate. Those who have not made, it might be difficult for them to recollect things. But yeah, this was the main crux of, telling you what is your lease liabilities and your financial liabilities. Now, there are few steps also. There are 5 things that how will you define what is an operating lease and a financing lease. You'll get that online. But major is this only, that lease should be given, the lessee should transfer in the name of lessee, and he should have the right to use it. The lessee will have the right, it has the entire right. That is why you report right of use. It is not your own assets. You have having the right to use, but you cannot say it is your own assets. And this was a good step from a accounting perspective, that an analyst who is looking at the financial statement do understand, okay, these companies also have liabilities on their assets on their books. That is why they are able to generate assets. Okay. Okay. Any doubts? Now I'm opening the floor for questions. If you have any doubts, just raise your hand. I will unmute you. Adil, any doubts? Ritik, Advait, these are my students. I hope you have cleared. Where is Kushak today? Okay. I hope, Ritik, it has been clear. And this is also a part of CFA. Same thing is used in bond valuation. Same thing is used in bond valuation. Now, Satyam, in IFRS, they have not mentioned. So it is not. In IFRS, it is assumed it is finance lease only. That is why this, to remove this operating lease, that is why this concept has come up. You have to remove this altogether. And IFRS 16, you don't report only as operating lease. All reported as part of financing. This is only how you report. This is only how you report. You tell it your own asset, because this doesn't make sense. And operating lease is only for smaller assets, like a showroom you take, or like an office space you take, a small. When you have big assets which are directly related to your sales, you cannot take it as your operating lease. It is a misrepresentation on the balance sheet. Now this is a part of your non-current liabilities as well. Non-current liabilities as well. Non-current liabilities in the FSA book. If you're doing CFA level 1, it is a part of non-current liabilities. You will get the same question. Now here the things are coupon. They talk about coupon rate when it's a bond, this is a beginning value of the bond. They talk about a coupon rate. They talk about interest will be same, principal repayment and the closing balance. Because with the bonds, if it's an amortizing bonds, they do pay off every year. What is the value of the bond after 1 year? Ritik, see, that is an asset. So Ritik is asking that DLF is giving building corporate, but they build lands and build offices and give on rent. So that is not a lease, no? That is a part of your income, no? Ritik, you're not using that income to generate. It is like you purchase an asset and you give it on lease. So like, it's a rental income for you. If you have taken on lease, then you report it. Like you're giving on lease, it's your own asset, no, that you're giving on lease. Lease is what you have taken someone an asset, someone else asset to use it. DLF is your own asset only, no? It's like you give your flat on rent. So for you, it's your income, no? You will not report right of use. It is your own asset only. Okay. The concept, the year what happens in financial lease, the depreciation and you get a dual tax benefit over here. Usually you get a dual tax benefit over here. It's the only crux of reporting like this. And it's just financing, it's just part of financing. Part of reporting rather. Accounts is made difficult, but I would suggest that these are basic things that you need to understand. House loan, staying on rent, everyone understands. What is an EMI? What is staying on rent? And if you put little bit effort in finance, just reading, you know what is a cash flow from financing and what is cash flow from investing. Cash flow from operations. The only few things you have to remember. Rest all, finance is actually that we use on day-to-day basis. Or you must have heard it. But no, we have been told at a very different level. We are directly given a balance sheet and we are directly taught from balance sheet. I have teach in MBA colleges. I have seen students from first year, first sem, second sem, directly, sir, we have analyzed the balance sheet. Now, you never ever made a balance sheet of your own and you want to analyze the balance sheet. Now, I have seen student taking up, Tata Motors and doing an annual report, doing a financial model on that. The Tata Motor is such a complicated company. You will never understand where are the numbers coming from. But no, you go and analyze and you make a DCF. I will suggest students, those who are making financial models, even I suggest my students, if you make models, it should be on a very basic company that you know. You know in and out about the product. And that should be a very basic company. No exceptional items, no asset sold, no asset purchase. If you take more basic companies, it will become easy for you to analyze the. Yeah, for that FMCG sectors, auto sector, the footwear sector that we have done in our master course. Now this is an easy one. Okay. Now let's go on the exact model. Now this is the model that we had made. I will, okay. This lease liabilities, I will just mark it, those who want. Tab color, okay. Do it right, okay. So there's a model also which has been made, in this sheet. Now when you go through the lectures, go to the recordings, then only you will understand this sheet. Or else if you send it to your friends, they will not be able to understand what I'm talking about. Just removing all those parts. Things which are kept aside. Okay, now you can have a look at this. This looks easy, but it is not. It looks easy to do, but it is not. My concept, now you can go and look at the videos again. And my point over here for you guys, what to understand that what is the lease liability and what is the assets look like. Once you understand the concept, reporting is very simple. And just now we said how to report it. Okay. Satyam, what is your qualification, if I may ask? Because if you are a CFA or CA, it will be easy for you. But if you are a BCom graduate, it might be tough. Satyam? MBA fan. Okay, fine. Then it's fine. Okay. So this is like, it's not about being a commerce guy or being a science guy. This is common sense or maybe common sense reporting. You understand what are you doing, reporting becomes very easy. Okay, now over here in this model, now see, we have created a model. We have created a DCF. we have created a revenue breakup. See, we have done it quarterly and then we have done it annually. All the assumptions, this is average price, average selling price for premium brand, average selling for other brand from see where I've got these numbers from competitor companies, from conference calls. Then I have actually found out this numbers I have got. I have only got this number. See, 43 and 57%. This is what I've got from conference call, from the annual report. From this number, I have broken. We have broken up the revenues. See, this all revenues are not given. These numbers are not given on the annual report. I have seen students asking that, sir, we take how you do modeling. You just take a growth rate on this company. Historical growth rate, sir, 5 year, 10% average and do it. But see what we have taken. We have gone to the conference call. We have gone to the annual reports. The students have only done. I have not done that. My students have done this. And they have just found one number. I just told them how to break it up. I got the sales number. See, this is the revenue numbers from the annual report I got. It was said that premium brands was 43%. So obviously premium brands was 43. So other brands will be 57%. Other means a normal regular brand. So I got the sales. From the conference call, I got that average premium brand was, average price was 3,000. So 3,000 rupees average price per product. And the total sales was 9,000. So there I got the total volume sold. Or the total volume that is sold. And this I got it from competitors because other brands, there is not an exact figure, but an approx figure. If you go more deep, you will also find what is the average selling price for the other brands. This was not given, but I found it from other competitors that if Bata is selling at 600 rupees, Metro brands will always be selling at that same price only. 100, 200 rupees here and there. And we found the volumes. Because in financial models, volume into price, that is important. If you don't know volumes, if you don't know price, this revenue is useless. When you forecast that this revenue is useless. If you don't know how much products has been sold and what is the price that products was sold. So while doing breakups, you need to be more sure. And this data you get. If you do a bit of research, a little bit of more research, you get those data available. These are data that are available, or some data you need to use your own brains to find it. So when you go for interviews, you go and sell this model. He will ask you where you get this data. You have all written conference call this, and he will be happy. You only tell, you only tell as an analyst. I come to you. Let's say you are an investor. I come to you and I tell, sir, it will grow by 20% next year. I will ask how? Answer average growth. Will you be happy with my answer? You tell. Would you be happy? You are an investor. You are putting your crores of rupees into one stock. So it is growing because of average growth, last historical growth. If you go and tell him that, that this is the volumes that usually the company sells. And now I estimate as per industry growth, that the volumes will increase by around 1% on an average. That you can say, historically, industry data are available. You do Google, Crisil research are available. That what is the volume growth in the premium segment. You can at least get that cues. That year on quarter, the volumes are growing by 1%. This is all I have taken from the industry growth. Other brands, the regular brands, the volumes are growing by 5%. This is growing by 1%. So if the industry is growing by 1%, obviously you can also assume that your company will grow by 1%. And the price hikes. As per the inflation, you can take the price hike. You can at least tell the interviewer that you have done some research on a company, not just directly coming and revenue estimating. I as a manager, hiring manager, I would have if you come out with this model, just growth, I will grind you on financial topics. I will know that I know that you guys don't know about company and all. You have just come and you have made this model because it was been taught into colleges or schools. I was hiring a candidate. I asked him that why did you make this model? Sir, because it was taught in college. Just it was taught in my classes. So I have told my students, you should not do one model, you have to make 4 models. And from that 4 models, you select one model, which is the better company for you to analyze and give it in the interview. And then you say that, sir, I have done metro brands because of various reasons. Okay, so Advait is there in the class, he had got the role based on this only, that he had convinced his interviewer that why he has taken this stock for analysis. Why we choose metro brands. Though it might be any reason, but he should have some reason. It should not be that, sir, because he was taught in colleges. And he also had the answer that why Bata is not good or why the other campus and activewear are not good. On that basis only he got a role. He was a sales guy going into BCom graduate, not even an MBA. And then he cracked a research role. And if you guys can also do it based on the models that you make. Okay. Okay, now let's so I've got these numbers. Okay, this lease liability. Now, how to forecast this? How to forecast this lease liabilities, right of use assets? I have done some analysis over here. Okay, so this is the number I have got it from the annual report. I'll show you the annual report. When you go to annual report, thank you, Deepak. In the annual report, you will find now in the index, you will find 194. Page 194 is your financial statements. 194. Sorry, 194 consolidated, and there you get right of use assets is 2B, and the lease liabilities is around 30. 2B and 30. Okay, let's go to 2B first. This assets are same as your normal regular assets. This has been treated as same as your purchasing PPE. This is same as treating your PPE. What is it? It started with, okay, I will take a snapshot of this. 1 second, guys. So I will take a snapshot of this and keep it with me. Okay. This is 2020. Okay. 2020 till 21. 22 we have the numbers. Okay. Copy. I will keep it over here. This side. And same thing what I do. I will go for lease liabilities now. Let's go to lease liabilities and find. It was 30. This is see, lease liabilities, right of use assets. Now here obviously you will not find any correlations because I told you what happens is that in the lease liabilities, the closing numbers, you see, the closing number for lease liabilities was 1 lakh, it was 83 lakhs the next year. Here it was what? It was 1 lakh and 80 lakhs. You see the difference? And this is how the lease and liabilities starts changing. This is how the lease and liabilities starts changing. Now here, let's go to this sheet. Okay. This was right off. The beginning of the year was 49 lakhs, 49,000. This was as at March 2022. As at March 2022. 2. So you will never find numbers which are similar. But you see this? This is something similar. 49,000. What have they done? They have added 22,000 of more lease assets, right of use assets, disposal, this they have disposed, and depreciation expense for this. And this is the balance sheet. This is the number. You see 06,698, it's tallying with this amount. Got the breakup? Got the breakup of what they have done? The numbers are okay. Lease liability, let us see what was the lease liabilities over here. This was the second part of lease liability. I will pick it over here. Second part of lease liabilities. So was first part. I will again maturity analysis on contractual undiscounted cash flows. This is what you will talk about PV. This is 4 things we got. And that's it. Okay. You will be able to recognize these numbers. I'll keep it over here and make this again go to our balance sheet. Now, how does a balance sheet looks and this all things look like? Balance sheet numbers should always tally. Let's go to lease liabilities. 30 lease liabilities was 59,000. Okay. Lease liabilities was 59,000. It is over here. Lease liabilities was 59,000. This was current. Current is also there. Current liabilities was 9403. And this is the. Now, how is this derived? How is this derived? It was 48 and 48 became 59. What do you assume from this? When the lease liability increases, what do you assume? Can I say that they have taken more lease, and more lease will come with more assets. So once again, there's a doubt before we proceed. From FOs that company is growing by 20% and the industry is growing by 6%. Now, how will you choose a big difference? See, now these things, if you know the company is growing by 20%, then obviously you can take a growth rate of 20%. Now that is based on market share. See, this can only happen when the industry is growing at 6% and the company is growing at 20% when the market share is lower. When your market share is lower. Say Maruti. I will show you how it works. Maruti, Tata, Mahindra. Maruti sells 1 lakh units, okay, a month. Tata sells almost 50,000. Mahindra sells 10,000. Okay. Now the industry size is 1,60,000. I say that the industry grow by 10%. Let's take percentage wise. Okay. Percentage wise means this is the market share. This is the market share of the company, of the industry, 6%. Now what I say, this increased by 10%. The industry increased by 10%. Okay. That is 7,60,000. Now, if we keep the same market share, can I say this will be the number? Now, obviously, you say that if this company is growing by some higher percentage, so obviously the market share will increase. Now, you assume that, okay, Mahindra will take 10% market share in the industry. Mahindra will take 10% market share. So, if Mahindra has taken 10% market share, someone else's market share will decline. Let's say Maruti's market share declined. Mahindra took over the market share. Now, this analysis you have to do now, whether they're able to take the market share. Now, you see what is the growth. Now I say that Mahindra will take over. Now this data you get it usually, or the faster on that amount you get it. So this is like Mahindra will get 10%, and who will reduce now? Whose sales will decline? Maruti, because it is the highest one. This it is your analysis. I'm just giving a sample basis. Now you got your growth rate. Industry is growing by 10% only. So what is your growth? Maruti is 3 now, Tata is 10, and Mahindra is 76%. Okay, so you cannot take that, 20, industry is growing by 20%, so everyone will grow by 6%. So no one else. See, if your company is growing by 20%, so obviously it might be taking someone else's market share. Right? Do you agree? If your company is growing faster, so obviously someone else's company would have been declining. Okay. This is how you got your rate. This is how you have to change your market share. This is your assumptions for the future. Got it, Mahfuz? Okay, let's make a lease liabilities table. This was a lease liability table. Why it is not telling lease liabilities? So they have added both. 69, they have added this both. This plus this. Okay. Now we will do a lease liabilities. Just create a lease liability schedule for 2 years. 59,000. See, they have added both. 59. Let's take it from over here. 48. 48. That is your long term, and then your short term. Your lease liabilities, that is total should tally. Tallying 56, 9. Tallying. So this was your first year. It was FY 21. Now it starts with FY 22. Opening. So opening. Opening में long term, short term. Let's start with this. Okay. I am 23. I will not write this. I'm just showing you. I will directly write mixing both. Here it will be closing. How much? 56, 54, 9.59. This will be opening for next year. And what are they doing now? It works like addition. And then, we say that amortization. Or we'll say repayment. Okay, repayment. What is added? What is subtracted? Now, what we assume that lease are not been added. Okay. We assume that lease are not been added. Here it is said that for the next year, I'm assuming for the next year. So 22,180 was added. This was new. This was this year, 23. These are all other expenses which doesn't matter. Disposal during the year. Disposals are not required. Disposals was minus 2580.50. Then interest. That is interest that we know. Okay. Interest expense. Interest was 4302.97 and 4892.79. Okay. And lease payment during the year. Lease payment during the year. It was repayment of 6654.59. Okay. Lease payment during the year is minus. And this is how it. This is how it matches. Oh, sorry, I took the other numbers. Oops, sorry. 22, this was right. This was a part of it. 0.88. This was And what is remaining for a lease payment? Okay. It was lease 10, 382.45. Okay. 56, 22, 109, 4829, 10. This is reduction. Here, what is required for us is this is 5 minus 5.88. You know, if I ask you just now what we did, can I say that lease payment that we told, this repayment will go in cash flow from financing? This will go in financing. Interest, where you get interest from? Disposals, where you get interest from? The EMI scheme. Now, I say that this is your liabilities, okay? What I say, this is your liabilities. And you will get a number over here that how many years this lease liabilities are. Okay. Now, if you Google it, so not lease, if you just find it, I'm just finding it lease. Lease, you can do it as years. Payment of lease, okay. Lease improvements are amortized on a straight line basis over the period of useful life not exceeding 10 years, whichever is lower. Okay. That's fine. So you know that the year life is of 10 years. Life is of 10 years, right? Is it different for different companies? It has been depreciated at the 10 years. So usually there is 10 years. Or if there's a plant or machinery, it is 20 to 25 years. That's it. That's it. We got the number that is 10 years. So here, what I will do in my sheet, I have got these numbers. This is my historical numbers. Now, where will I get my forecasted numbers? Now, obviously, it will start with 24. Now, you guys tell me how will it work? I do the same way, principal, which I have done it over here. Principal, then your years is 10. We just now got it was 10, and then it was EMI, or maybe your repayment part. Repayment, that is your, sorry, it is a EMI, EMI part, and then there will be something called your interest rate that we don't know. Interest rate we don't know. Interest rate we require, no? Do you have the EMI amount? Do you have the EMI amount for this? EMI is equal monthly interest. We have, na? Can I add this both? Can I add this both? This 14,000, 15,000. 15,000 is my EMI. My total principal outstanding for the year when it started, okay, it was this. I got the EMI. Can I find the interest rate? Interest rate is easy. As a function in Excel, INT. Sorry, not INT. Rate. Rate function is a number of where you have 10. PMT per month you have paid this. Present value is this. And obviously put a negative sign because it will come in. The answer comes in negative. You got the interest rate. Is around 24%. Now, why it is so high? Anyone? Why is it so high? No, okay, disposal was also there, so I will take this also. Disposals. So one second. Did I took some? Oh. Sorry. Both, na? This also. I didn't added this. Sorry. And this total assets that are there is this much. Okay. Now you got 15. Now it looks more sensible, right? See why? Because this was from last year. This you added. The total assets that are this is disposed of. The total assets that you have at the end of start of the period was 77,000. And out of that, you have paid repayment was this and your interest was this. So you got your interest rate. Now can you do same thing? Just forecast. Forecast for the new year. Beginning balance, principal. Okay, EMI. We know EMI is around 15,000. Interest. This. Interest, principal repayment, and this is the closing balance. This will be done in the next 10 years. It will be done in the next 10 years. 1, 2, 2. If you do it, next 10 years will be there. Closing again. Second one, there's opening. Again, put an interest. This will be freeze, prepayment, and then your to do it. Copy 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You got it. You got a zero answer over here. That's it. Now what you will do, this is your interest expense for next year. This is your repayment for the coming years. Okay. Now you say, sir, what if the assets are added? What if the assets are added? Now for every assets, you have to make a different schedule because you have to make for 5. So you have to make a different schedule for 5. Now what do you do? What do you do? How do you forecast the next addition? See now here it is you add. This is for 1 year. See, I have done. See now I'm not saying this is exactly the same. It will be approx. It will be approx. It will be approx numbers, but still you got some number for forecasting. I have seen that, sir, what will be the EMIs next year? What will be the payment next year? I don't get it. What I've got. This is what I've got. Adil, interest. There's a function in Excel, the rate. In the calculation, in our financial calculate is I by Y. And I by Y that we find. PMT, how I got? We just now discussed how I got the PMT. Repayment plus the interest. Interest, rate, and then principal. And this was one part of your lease liabilities. Lease liabilities. With more 10 years you can do. Okay, this is the 10 years. Now let's come to the right of user sets. Right of user sets. This is the same, those who have followed my classes, those who are there, I said it's a gross block. It works like that. Same like an asset. Gross block, you opening balance, addition, that is capex, then it will be your less the capex, and then sold, less sold, and then closing. This is gross, this is accumulated, this is accumulation, this is accumulated depreciation. And the accumulated depreciation will come as again same opening, and add depreciation for the year. And then your adjustment. Now, there are a few adjustments which are there in the annual reports. And then closing. You can get it. Okay, let's go to this we already have. Right of use assets. This we already have the cost, addition, depreciation. And let us see if it's tallying with the balance sheet numbers. Balance sheet number is 60 and 49. Okay, 60 and 49. Tallying 60 and 49. Yeah, it is tallying. So it's the other way around. Gross, it was FY21. In the opening of FY21 will be 1st April 2020. Okay, 1st April 2020. So here now I can 57. No, rather than typing it, I will rather prefer to copy paste it. This is right away. That's 57. It was here. We'll put it over here. There was one more thing which was added, which was impairment. 50 addition, disposal, impairment. Now, this was impairment 102. And then there was a closing. For the closing, make sure the amount are same. 68. And then 68. Now this 68 will become opening for next year. Capex is around 24,000. Now Capex is the addition of right of use assets. Sold, disposal. Now there is no impairment. This is disposal. And then you get your answer here. 89. Now comes your accumulated depreciation. Depreciation at the start. Okay. 881. Depreciation for the year. Adjustment. There are no adjustments. Now the closing will be. The closing. This we have already done in a few of my classes. See now, always gross block is the amount purchased, cost of the asset purchase. Cost of the assets purchased. Then you subtract your accumulated depreciation. Subtract your accumulated depreciation. Then you get a net block. A net block is directly reflected in the balance sheet. But we need to understand that how much is the asset spent. What is the amount? So on an average, company has spent 68,000 amount to buy this. Means total value of the loan taken is 68,000. Now gross block is specifically the amount which is spent on purchasing the asset. Okay, that is why it is divided in two parts. Now, usually we do it directly, but here directly as in how we have taught opening, addition, less depreciation, and then closing. How we did it over here. How we did in our lease liabilities this way. But now when you have to talk about few other assets, you cannot do this way. So rather than creating every time a different asset schedule, add capex, you cannot do add capex over here. It becomes very what do you say? It becomes confusing. That add capex, and again you have to take a depreciation of this. That is why we just divide it into two parts. One which was actually purchased, and what is the total depreciation charge till now. Depreciation for the year. Now this will only be you will be able to do if you are doing the modeling on regular basis, or else you will not get this. What I'm doing. 60,000. You got it. 22. Let's say I have to forecast for 23. I have to forecast for 23. Now what numbers I got from over here? See, I got few numbers, which is depreciation. See, first of all, I got depreciation rate. Now, I guess it will be around 10% only. Depreciation divided by 14%. 12%, because we had said that it is around that useful life is around not exceeding 10 years. So approx, because there's some adjustment also. That is why it is depreciation rate is around 12%. So what will we assume? That we'll assume 10% only, because we know the useful life of 10 years, useful life of 10 years is as good as saying 1 divided by 10 into percentage, which gives you 10 percentage. 12% useful life is as good as saying 1 divided by 12%, which is 8.6 years. Okay. Deepak, we found now. So Deepak is asking taking average closing balance. So we just saw now that lease liabilities are around 10 years. We are getting this difference because of some accounting adjustments, but it's around the same, around the same years. It will take 10 years because this we got it from our annual report. So now how will you forecast capex? How will you forecast capex? You can take average also, no point. If you are doing for other gross assets, now you can take average also. That will be totally fine. The average will be around 13 years. Yeah, that's totally fine. But for that, you should have a lot of data. You cannot just take 2 years data. You should have at least 5 years of data. It is 10 years. How it has come from annual? I will write a note from annual report. From annual report. Okay. Now, useful capex as a percentage of sales. As a percentage of sales. Okay. Now sales, we don't have. Sales we have. I have the sales over here. So capex means this is the capex that company has done on the sales. We have 21. Okay, we have the numbers for 21. 21 numbers. There's this. And this is not actually a capex. Okay, this is okay. Sorry, these numbers are in crores, I guess. These numbers are in lakhs. Sorry. But these are in lakhs, these are in millions. So lakhs will be divided into. Students, how to do lakhs into crores? These numbers are in lakhs. My numbers are in millions. How do I do it? These are in lakhs, but my numbers are in millions. So I have to grow from lakhs to millions. Lakhs. How to do Google? Those who don't know, few of my students must be knowing this. Lakhs have 5 zeros, millions have 6 zeros. You are going up the value chain. So when you go up, means obviously lakhs is smaller number than millions. This number should be smaller. So you should divide by 10. So we'll divide this number by 16%. Okay. Around 17% is around the capex. So 16% is my capex. Now I will assume that the 16% is my capex. Next year, what I will do is opening. Capex will be now 16% of my forecasted sales. Of my forecasted sales. Now 23 is already come, but telling you, if you don't have the forecasted sales. Forecasted lakhs to millions. You 5 zeros, no? 5 zeros are in lakhs. And millions have 6 zeros. So the difference is only 1 zero. The difference is only 1 zero. When the difference is only 1 zero, obviously lakhs is a smaller number, million is a bigger number. So obviously when you convert this lakh into million, obviously you know that this will be a smaller number. Now because million is a bigger one, you are going from lakhs to million. You have to divide by 10. Okay. Okay, fine. Got it? 16%. And then I have no disposal dividend project. Accumulation over year. Depreciation for the year. Depreciation we have 10% of the total assets. And then you got your assets. You got your assets. You got your depreciation. And then this is for 23. Write off use assets. Now what you will do now, this is the new assets, no? This is the new assets that was created. Now again create a same like this. Your beginning balance will be this. Because obviously you cannot add it over here. Every time you cannot add it. Because if you add it, the EMI will change every time. So what you do? Second principal, asset one. Same way you can do it over here. This obviously have to do in two different sheets and do principal same way. Everything is same. Now here interest rate we will get. Now interest rate we will put it this way. Yours, so we know it is 10. Now can you find the PMT? Now principal will be this new assets is our new principal. Yours we know it is 10. PMT now you can find PMT. Rate is 15. NPR 10. Present value. Now make sure you put the present value in minus. Same stuff. Same way for now. There's no other way of doing it. This is the only way of forecasting your. But our main was this. It was hardly any number over here. But our main was this. You see, you get the answer. I just copy pasted it. I got the answer. Now every time when you do, you have to do this. There's no other option to do it. Every time next year you add an asset, same way it is just adding every time and then add all the interest expense at once. You will get your interest rate assumptions for the forecasted years. This is how it works. Okay. We do it 2, 3, 4, 5, 6, 7, 8, 9, 10. It will be 0. Okay. This is how you forecast every time. Assets added, lease liabilities added. Now you can add this, both liabilities, and put it in the balance sheet. This also repayment, you can put it. Okay. I'll show you in my model. I have already a model created. I'll show you how it works. I'll do it for 1 year. What happened? My lease liability was 77, right? Now it will be what? My closing balance will be 73 for the next year. So I have my balance sheet over here. Okay, now they have said that this is club, no? This was club. 69 was club, no? It was club. So I will just change it with the EMI amount. Interest was, see, what I will do, 69. This was right. There was no addition. You don't assume any addition. No disposals. Interest was this. And repayment was this much. 1 second, guys. 1 second, guys. Just a minute. Yeah, sorry. Now you don't assume anything, okay? You don't assume anything else. Right? This is the repayment. This is the interest. Now this can be reported in the lease liabilities part. See, I will go and report this in my lease liabilities. Balance sheet. 24. I have my lease liabilities. This was non-current. Sorry, it was 22. Sorry, it was 22. So 23 balance sheet is not given out, but I would have done it over here and then I would make the changes in my model. Since the numbers are different, I will not be able to do it. 23 it should have been 24. We have to also take 24 numbers. Okay. And 23 numbers I have already got. 23 numbers I have already I'll not be able to do it now. But yeah, if it was 24, I would have been able to do it. I think we can do for 24. We have to change the numbers over here. Then here the closing balance we have already got. Okay, we have to change the numbers over here because 23 numbers have already been. Annual report is not out, but the numbers are out. So we could have done it. But this is the way you do it. Okay, this is the way you do it. For 23 now, what happens if 23 numbers are not available? You take the closing balance. Closing balance was different. This was I think 22. 22, it was 23. So opening was this. Closing, what is it? Add the both. Add your both. In this, you could have this plus the lease liabilities. This to you add. And you will get the closing amount. Okay. Fine. So guys, I will upload these videos on YouTube. So I have sharing my channel link. Okay, I'll share on LinkedIn. You guys can check on LinkedIn. Here, I need to open my channel once again. Let's see if we can. Okay, so any doubts before we sign off? Any doubts before we sign off? It was good having you guys on board. I'll share this again on YouTube. You can have a look at that. Other students though. So I've also started a classes, equity research master course, which will be starting from 4th September, and weekend batches on 9th September. So if you guys are really interested in getting into research, you can contact me. This was purely for educational purpose. Even my students find this issue. So I've created these videos for them as well. Others also who are interested, always welcome. I'll share this file. I will share this file here only on my WhatsApp. On the. Okay, if you like this video, please do subscribe my channel and like the video if you like. Okay, I will share the link there only, the Excel link in the YouTube channel as well. In the comment section, you can download it because it's taking time for me to reload. Okay. Thank you guys. Thank you. Last question. Any doubts? Any doubts before we sign off? So weekday course is around 6 weeks and around 45 days. So 4 weeks financial, 1 month financial modeling will be done. After that, it will be around 2 weeks for report writing. I'm sharing my YouTube channel link. Okay, I'm just sharing the. Oops. I'm sharing my YouTube channel link. You can I will upload the videos. There are a few videos on deferred tax assets as well. Deferred tax asset, deferred tax liabilities. You can. You can see there. There's also introduction of master course I have seen. You can go through the videos and you can see what all things will be taught in the classes. And on LinkedIn, if you follow me, I have put everything there. You can also join the WhatsApp group. I have already shared the link in my LinkedIn channel. You can join the WhatsApp group and all are welcome. Yes, sir. Ritik, Paridhi, my students. Got it? Shivesh, Inandu. You got what is these liabilities? I think Kushagra was asking, is not there today. Fine. Thank you. Thank you, guys. Signing off. Have a nice weekend. Thank you, Advait. Bye-bye, guys.